Welcome to the Economist in Your Ear podcast. Have you ever considered what truly underpins the incredible financial might of institutions like Harvard and Yale, beyond just their reputation and centuries of tradition? Today, we're pulling back the curtain on why elite universities are tapping into global debt markets in a big way, and the fascinating, perhaps surprising reasons behind their seemingly enviable borrowing costs. It turns out it's about so much more than just a famous name on a diploma.
Exactly. The Economist suggests a prestige premium is at play, which is certainly an interesting idea and holds a piece of the truth. But when we look closer, it's a far more complex picture. We're going to unpack what else is really driving these massive financial decisions and how the market truly perceives these institutions. As we'll see, it's less about the halo of a brand name and much more about the rigorous financial underwriting that happens behind the scenes.
Okay, let's unpack this then. The Economist article highlights that Ivy League universities have been on what it calls a significant debt binge. When we talk about a debt binge, what exactly does that look like in terms of the numbers, the recent activity?
Well, the numbers certainly tell a compelling story. Issuance really has picked up significantly. We've seen titans like Harvard, Yale, and Princeton, for instance, raising sizable deals specifically for fiscal year 2025. And they're using a mix of both taxable and tax-exempt bonds, which points to some pretty sophisticated financial engineering going on. If you look at the collective figures since January, Ivy League universities have issued over $1.7 billion in debt. To put that in perspective, that's the most they've collectively borrowed in any year since 2020. So it's not just a casual uptick. It's a deliberate and, substantial increase in their borrowing activities.
Wow. Okay. $1.7 billion since January. And what's truly notable about this, I guess from an investor's perspective, is just how incredibly tight those spreads are. For those maybe unfamiliar, when we talk about spreads, we mean the extra yield investors demand above a risk-free benchmark, like U.S. Treasuries, right, to compensate for risk.
Exactly.
And these new Ivy bond issues, they're clearing at only a few tenths of a percentage point above the Treasury curve.
That's right. Tiny margins.
To give a comparison, that's like what you'd see from a top-tier AAA-rated corporate like Johnson & Johnson, which typically trades around, 0.34 percentage points, 34 basis points above Treasury?
Precisely, a basis point being 0.01%.
So this pricing really illustrates just how money-good investors perceive this paper to be. They see it as incredibly safe, almost like government debt.
Yeah, pretty much. It really does. And this perception, it leads to a very clear bifurcation in the market. The ratings agencies, they consistently confirm this. On one side, you have these dominant brands, the Ivies, enjoying access to incredibly cheap capital, almost like they have their own exclusive lending club. Meanwhile, on the other side, weaker schools, maybe less famous ones, they face significantly higher costs and sometimes, even limited market access altogether.
So bifurcation isn't just a fancy term here. It sounds like it's a stark reality of almost like two completely separate markets for university debt, one for the elite and a much tougher one for everyone else.
Precisely. It's a huge divide. To give you an idea of the scale, take Pepperdine University, for example. Their bonds, they can trade at more than 2 full percentage points, that's 200 basis points, above corresponding treasuries. 200
basis points compared to 30 or 40 for the Ivies.
Exactly. It's a huge gap. And it just powerfully highlights the vast difference in how the market views these institutions financially. It's a testament to the fact that, while all universities have mission statements, not all balance sheets are created equal in the eyes of the bond market. Not even close.
That's a massive difference. And it seems there's a clear pattern when you look at the data, right? If you connect this to popular metrics like the U.S. News & World Report rankings, the higher a private university's standing, the lower its borrowing cost seems to be. The Economist points out this directly reflects the size of their endowments, which makes sense. It's a major comfort to creditors.
It's like in the corporate world, right? Bigger firms, bigger balance sheets, more diverse revenues, they get cheaper rates.
Yeah, and it says here all the top 15 private colleges have tapped bond markets, but fewer than 60% of the next 45 have any outstanding bond debt. The market clearly trusts the balance sheet depth and fundraising power of these top-tier institutions in a way it simply doesn't for others.
It's absolutely true. The sheer scale and the resilience of their financial foundations provide just an unparalleled level of comfort to bond investors.
Okay, here's where it gets really interesting for me. The Economist attributes this largely to a prestige premium, the idea that their name, their reputation alone allows them to borrow so cheaply. But is it truly just the name and reputation? Or is there a more complex financial story under the hood that maybe isn't immediately obvious? When you really dig into the financial plumbing, What's something surprising that investors actually prioritize over just a famous name?
That's a really important question, and it's where we can add some necessary nuance to the discussion. Because while prestige certainly plays a role, I mean, you can't ignore it.
Yeah.
The full picture is far more intricate than just a famous name. For investors, it's less about the sort of aura and much more about structure and balance sheet resiliency. Imagine trying to get a loan based on your famous last name versus getting one based on a pristine credit report, a diversified investment portfolio worth tens of billions, and a steady stream of income from multiple businesses.
Right. One's about reputation, the other's about hard financial facts.
Exactly. Investors aren't just betting on a famous logo. They're underwriting a financial fortress. That's the real prestige premium, if you want to call it that, the ability to build and leverage that kind of rock-solid financial foundation.
So it's less about the halo, more about the hard assets and income streams backing it up. That makes a lot more sense. Can you give us an example of how that financial resiliency plays out? Say, in a downturn where their name alone wouldn't cut it?
Absolutely. What investors are underwriting is, first, the sheer size and diversification of their endowments. For places like Harvard or Yale, we're talking well over $40 billion.
Or billion, with a B.
With a B. Then there's their broad and deep fundraising capacity, often generating hundreds of millions, sometimes billions, in donations annually. Beyond that, they have significant and crucially reliable research revenues, much of it from federal grants, and substantial liquid reserves that they can tap quickly if needed. That's why institutions like Princeton and Harvard maintain those pristine A-Blade credit ratings the highest possible, and why they're pricing clusters with top-tier corporates. It also involves how they structure their debt. They use these things called 501c3 conduits for tax-exempt purposes.
Okay, what are those exactly?
They're basically special nonprofit entities that allow the university to issue bonds where the interest isn't taxed federally. So cheaper for the university, attractive to certain investors. But they also sell taxable bonds, which gives them much greater flexibility. They can use that money for a wider range of things, maybe not tied directly to the nonprofit mission like general working capital or even certain endowment needs.
Okay, so it's an incredibly sophisticated financial operation, really, not just coasting on reputation. But you also mentioned macro and policy overhangs being material. How do broader economic and political factors play into these borrowing decisions, especially for institutions that seem so financially secure on the surface?
Oh, they play a huge and, frankly, increasingly prominent role. Since March, Moody's, a major credit rating agency, actually shifted its U.S. higher education outlook to negative.
Negative for the whole sector, even the Ivies.
For the whole sector. Now, it doesn't mean Ivies are suddenly risky, but it reflects sector-wide concerns. This is due to federal policy shocks and potential changes in funding or initiatives related to diversity, equity, and inclusion, DEI. These are risks that matter even for elite institutions because a significant slice of their cash flow, particularly for the research-heavy universities, is directly linked to federal research grants.
Right. Federal funding uncertainty.
Exactly. This whole macro backdrop helps explain the borrow now, ask questions later pace we're seeing. Institutions are pre-funding future capital expenditures, new buildings, tech upgrades, and trying to cushion against uncertain federal grants or potential regulatory changes down the line. It's a proactive, strategic move in a period of heightened uncertainty, making sure they have the liquidity to navigate whatever shifts might be coming in the funding landscape.
That's fascinating. So part of this debt binge isn't just grabbing cheap money for shiny new projects, but also building a financial buffer against potential future headwinds and policy shifts. And that leads me to another point you mentioned, debt as liquidato insurance. What does that actually mean in this context, especially for these massive endowments?
Yeah, this is really interesting. It's less about leveraging up just for the sake of it and more about shrewd liquidity management. So recent endowment reports showed respectable returns for fiscal year 2024. Which sounds good.
Sounds pretty good, yeah.
But private equity, PE, and venture capital, VC investments basically, stakes in private companies that aren't traded on public stock exchanges, they're still lagging behind. And critically, illiquidity remains a significant issue in those private markets.
Meaning it's hard to sell those stakes quickly for cash.
Exactly. While these investments might hold great long-term value, you can't easily convert them into cash quickly without taking a significant discount, a loss. So we've seen several mega endowments, Yale included apparently, exploring secondaries, which is basically selling off these illiquid private equity stakes on a secondary market just to raise cash.
Yeah.
So borrowing cheaply in the bond market, it helps them extend their runway, gives them breathing room. They don't have to sell these illiquid assets into weak private markets at a bad time. They avoid a fire sale, essentially.
So they're using cheap public debt to avoid having to liquidate valuable but currently hard to sell private assets. That's a very sophisticated financial maneuver.
It is. It's sensible cash management, gives them flexibility.
Yeah.
But it's important to remember it's not costless if interest rates stay high for a long time. There's still interest to pay on that debt.
Right, of course. And then there's the political angle, which feels particularly relevant right now, doesn't it? With so much public discourse around universities. You mentioned political risk is now a credit variable. How does that actually manifest in their borrowing costs, even for institutions this strong?
Yeah, this raises a really important point because it's a crucial nuance many might overlook. We've actually seen how Harvard's confrontations with Washington, threats to federal funds or even questioning their tax-exempt status as a nonprofit, have already affected their bond trading levels.
Yeah.
And even deal discussions for new bonds.
Really? You can see it in the prices.
You can. It's a clear reminder to investors that even pristine credits, the supposedly safest of the safe, carry headline risk. For example, if there's a negative news cycle or a statement from a policymaker hinting at legislative action against these universities, bond traders react. This increased perceived risk can and does widen Ivy League spreads. It pushes their borrowing costs up, maybe not dramatically, but measurably. It demonstrates that even the most financially robust institutions aren't immune to external political pressures, regardless of how impressive their balance sheet looks.
So it's not just a theoretical concern. It's actually playing out in the market. Public perception, political wins. They can have tangible financial consequences.
Absolutely. It's a real factor now in the credit assessment.
So what does this all mean then for how we understand these institutions' financial strategies? It really sounds like the prestige premium idea is perhaps too simplistic, almost a surface level take on a much deeper, more complex financial game being played. What's maybe the biggest misconception people have about what actually drives these deals?
I think if we connect this to the bigger picture, calling it a pure prestige premium really undersells how credit is truly underwritten here. The biggest misconception is probably thinking the name is the primary asset. It's not. The first-order drivers of pricing for these bonds are overwhelmingly the true financial fundamentals. The sheer scale of the endowment, the level of unrestricted liquidity they hold, the breadth and loyalty of their donor base, which is huge, and their robust, often federally backed research franchises. These are the core pillars. And, these factors can even diverge meaningfully within the Ivy cohort itself. Not all Ivies are created equal financially, even if they all borrow cheaply compared to others. Their underlying strengths differ, and that gets reflected subtly in pricing.
And it also sounds like The Economist's article, while insightful, might be underplaying some of the potential downsides or risks these institutions face, despite their seemingly bulletproof financial positions. What are some of those less talked about risks?
Absolutely. I think the article perhaps underplays potential downside scenarios that could make today's cheap leverage look far more expensive down the road. We're talking about things like prolonged private equity markdowns, where their illiquid investments continue to struggle. That could force them into more difficult liquidity choices than just borrowing, or tighter federal regulations, things related to foreign entities of concern, changes in visa rules, research funding rules, which could directly impact their revenue streams, especially the research-heavy ones.
Right, the federal tap potentially tightening.
Exactly. And there's always the broader risk of a sustained Treasury sell-off. If Treasury yields shoot up, that reprices long-duration debt across the entire market, making their existing fixed-rate bonds less valuable on paper and future borrowing more expensive. Recent rating adjustments and policy moves, they clearly show these aren't just, far-fetched tale fantasies. They are real material risks the market is starting to grapple with, even for the highest-rated institutions.
And there's also the nitty-gritty you mentioned of how they're allowed to use the money they borrow. That ties back to that financial plumbing idea. How does that impact their choices between, say, taxable and tax-exempt bonds?
Precisely. You can't forget the use of proceeds constraints. Tax-exempt bonds, remember those cheaper ones, they come with strict rules. Generally, they can't be used to, say, gamble on alternative investments or just cover general operating expenses not directly tied to the university's core nonprofit mission.
So limits on how they spend it.
Right. And that's a key reason why many schools opt for taxable bonds, even if they cost a bit more. They offer much greater flexibility in how the funds can be deployed. whether it's for less restricted capital projects or for that liquidity insurance function we talked about, bridging gaps or managing endowment cash flow. Again, this is much more about sophisticated financial plumbing and strategic capital allocation than just the sheer power of their name.
It's almost ironic, isn't it? For all their academic prestige when it comes to borrowing, these institutions are acting like incredibly savvy financial entities, making calculated moves to optimize their balance sheets.
It really is a different lens to view them through. This has been incredibly insightful. For someone listening now, what should they be watching for next in this space to see how these trends evolve and maybe gauge the true financial health, or at least the market perception, of these elite institutions? Yeah, there are a few key indicators worth keeping an eye on. First, watch for spread discipline. Will new ID bond issuances continue to clear within that incredibly tight range, like 30 to 40 basis points above U.S. Treasuries? Or will increasing policy noise, political risk, the broader macro environment push them closer to what their AA-rated peers are paying?
So watching if that gap widens.
Exactly. That spread is a real-time indicator of how the market is assessing their risk profile. Second, pay close attention to rating outlooks from agencies like Moody's or S&P. Any further shifts in outlooks, or maybe formal reviews specifically tied to federal funding disputes or political interference, those would be incredibly price-moving for their bonds. It would signal a fundamental reassessment of their creditworthiness due to those external pressures.
Okay, ratings and spreads. Anything else?
And finally, I'd look for data on secondary sales of private equity and venture capital stakes. If you see a pickup in these sales, even if endowment returns look okay on paper, that would strongly signal that universities are continuing to prioritize immediate liquidity. It tells you they're still actively managing that illiquidity risk in their endowment, despite whatever headline return figures they might report.
Got it. Spread discipline, rating outlooks, and secondary PE/VC sales. Key things to watch. So, when you hear about elite universities and their financial strength, remember it's not just about their centuries-old names or even the headline size of their endowments. It's this really complex interplay of deep financial structures, shrewd risk management looking years ahead, and even the shifting winds of policy and politics. There's always, it seems, more beneath the surface.
Indeed. It truly encourages us, I think, to look beyond the obvious headlines and consider the underlying drivers of financial decisions, even for the most established, seemingly unshakable institutions.
Thank you for joining us for this look into debt, diplomas, and dollars. We encourage you to consider what other widely accepted narratives about powerful institutions might benefit from a closer, more critical look at the financial data beneath the surface, challenging what we think we know with what the numbers might actually show.